possibly might not work. So again, you don't want to just move all your chips in at the beginning of a new market uptrend. As you can see, the rally failed because this low was taken out here. Again, it was institutional selling. And then you had a little rally attempt right here. This was back in September 1974. You had day one of a rally attempt, another follow-through day here that ran into trouble. This low gets taken out. So just keep looking for follow-through days when the market's in the throes of a correction. Just keep looking for a follow-through day and see if it works. Now, here was day one of a rally attempt right here. Remember the two successive follow-through days that we saw in the NASDAQ back in 1998? Well, the same thing happened in 1974. You had two big percentage gains. Volume picked up each day, and that ultimately marked the start of a new market uptrend. See, it did take a little while for the market to get going. Here were your two follow-through days right here. Went into a little consolidation, but then the S&P 500 had a big breakout here in higher volume. Again, the fact that this low was never taken out, the rally was still intact during this whole time. You may not have been aggressively buying stocks because the uptrend was not clearly defined yet, but the fact that this low was never taken out meant that the rally was still intact. You can see the S&P 500 in 1974 was up 30% in 6 months. Not a huge rally, but again, another opportunity if you were looking at the right stocks, fundamentally and technically strong stocks, there were opportunities to make money. So now you know how to identify when stocks could be ready to start a new uptrend. But what about market tops? Do the major stock indexes flash warning signs that a correction could be right around the corner? You bet they do. It's all about recognizing when big investors start unloading stock. Okay, that takes us to our market tops section. Market tops are generally going to be put in when institutional investors start selling stock. It's really as simple as that. You're going to see a lot of heavier volume declines in the indexes. You're going to see leading stocks that led the rally start to roll over in heavy volume. So identifying market tops is really about understanding when institutions start selling stock. So let's take a look at the 3-year bear market. That really started in March of 2000. This was another situation where the market was just getting taken apart by institutional selling. There was a lot of excess in the market. The tech bubble burst in March, April of 2000. You can see the market did stage several rally attempts where you did see follow-through days, but again, they just really did not have much staying power as the market worked out the excess that was built up during the bull market of the 90s. Remember, a distribution day is a heavier volume decline. It's a sign of institutional selling, and when you see distribution days start to crop up after a follow-through day, it is a sign to start getting defensive. Remember, follow-through days can sometimes mark tradable rallies, so you may not see a huge market uptrend, but it might be a 2-3 month rally where things are working. Distribution days ultimately impede that market rally, and that's really what you had several times during 2000-2003. See a lot of tradable rallies here. One here, you had a follow-through day. Distribution days got in the way of that rally. Lengthy downtrend, another tradable rally here, another one right here. Just too much professional selling in the market. And again, we went over the March 2003 follow-through day. Eventually, the NASDAQ was able to confirm a new rally right in this area here. Let's take a look and see how stocks topped in 2000, because IBD was right there in print telling investors that stocks were topping. And again, it was just recognizing when institutional investors were starting to sell stock. The first distribution day for the NASDAQ occurred on this day right here. You can see it touched a high right around 5,000. But you can see a heavier volume decline. So this was distribution day number 1. NASDAQ rallies, touches another high. Point 2 here really just highlights negative price action. What happened here was the NASDAQ went and hit another high, but you can see how it closed right at its session low and volume picked up. So when you see this type of price action, whether it's an individual stock or a major stock index, this is called churning. So you have heavy volume without further upside price progress. So you had a reversal where the NASDAQ closed near its low in higher volume, plus the fact that it closed mostly unchanged from the prior day. So that's called churning action, and it was negative price action. So you had a distribution day here, churning action here, another yellow flag. This was a lower volume decline. But then you had a big distribution day here. NASDAQ closes near its low. Volume picks up again. So you're seeing signs of institutional selling. 3 days of negative price action in the NASDAQ. Another decline here in lower volume. And you see the NASDAQ start to rally back. This is a lower volume decline here, not a distribution day. NASDAQ starts rallying back. So looks like it's going to test its prior high, but look at what's happened. It's rallying in weak volume. Okay, so volume is below average. There's really not much conviction behind the buying. So you had 3 days of negative price action here, and now a rally attempt in low volume. Again, the purpose of showing you what the NASDAQ did in 2000, this is not a case of hindsight being 20/20 or a rear view mirror look at the market. This is about recognizing what signs of weakness look like, because this is going to happen at some point in the future as well. So if you can learn to recognize abnormal or unhealthy price action in an index, you'll be able to lock in profits in stocks. So this weak volume rally here was a sign that the NASDAQ was running out of steam. Then you had another distribution day right here, another one the very next day. So just so many distribution days in the market. This was really reason enough to get out of the market here. We're still only talking in April. So there were signs to get out of the market. And a lot of investors reading the big picture had already started locking in profits in tech stocks that they had big profits in, because that's what the big picture column in IBD was saying. A lot of distribution going on in the market, time to get off margin, time to be getting defensive and locking in profits. Okay, so you just had a lot of distribution. You can see what it ultimately did to the NASDAQ. It forewarned of further weakness. Then the NASDAQ really started falling apart. So, recognizing market tops is understanding when institutions start selling stock, and that is seen in increasing distribution days. We talked about the fact that during a follow-through day, a lot of leading stocks are going to break out of bases. Well, when institutions start selling stock and stocks in the market begin the topping process, you're also going to see leading stocks start to roll over. So all these bull market leaders during the late 1990s started selling off in heavy volume. And this is just sort of a brief look at our model books. And we have model books of how these stocks topped, and all of these ticker symbols topped in heavy volume, and you can see they were doing it, not surprisingly, when the general market was topping. Again, the big picture was right there, telling readers when distribution days started cropping up in the indexes. Here you had a little tradable rally later in the year in 2000 that marked a nice little rally, nothing big, but then again distribution days start to make their presence felt, and you get another sell signal in the market because of heavy institutional selling. So it's just really important to read the big picture column every day in Investors Business Daily. It's just an objective, no-nonsense look at the market. When the market is up, it's generally going to tell you if big investors fueled the move. If the market is down, it's going to tell you the same thing. And it's also going to monitor the action in leading stocks in the market. Okay, let's take a look and see how stocks topped in 1998. Again, rear view mirror? No, it's about recognizing signs of institutional selling, so this will help you in the future when the next bull market starts and ultimately rolls over. You'll be able to recognize these signs of weakness. Okay, we went over the NASDAQ follow-through day, the S&P 500 follow-through day in mid-October 1998. Well, the NASDAQ eventually started showing topping signs. Again, starting with a reversal in heavier volume, distribution day number 1. Here was distribution day number 2, so you had 2 in 3 days' time. Here was another distribution day, so you have 3 in 6 trading sessions, signs that institutions are starting to sell stock. Distribution day number 4, you can see, nice uptrend here, signs of institutional selling, time to start getting defensive with stocks in your portfolio. Maybe not locking in full profits, but starting to take some money off the table. NASDAQ breaks through its 50-day moving average. That's his red line right here. The 50-day line is normally a key level of support, but it went underneath the 50-day moving average. Then you had another distribution day. So you can see what institutional selling looks like in the market. What happened was the NASDAQ went underneath its 50-day moving average. You had distribution day number 5 here. And look at how the NASDAQ tried to rally back above the 50-day line. What was once a level of support now turned into resistance. So this was key price action as well. The 50-day moving average actually turned into a ceiling for the NASDAQ, which was just yet another sign of technical weakness. Then the NASDAQ goes through its 200-day moving average, another distribution day. Notice the volume was really huge, much higher than any other former down day. NASDAQ ultimately goes down 33% in 12 weeks, so a nasty bear market. 1929, the stocks topped just the same. There's so much historical precedent to not only follow-through days marking the start of new market uptrends, but also how distribution days can mark an index's top. See, in 1929, there were 5 distribution days right at the top here that ultimately sent the Dow much lower. So that concludes our market timing section. Just to conclude briefly, remember, when the market is in correction, you always want to keep an eye out for a follow-through day. No bull market has ever started without a follow-through day, but keep in mind that not every follow-through day launches a new bull market. We showed you some examples where they don't work, but it's always important to recognize when at least one major index makes a big percentage gain in higher volume on day 4 or later of a rally attempt. Remember, after a follow-through day, you also want to make sure there are plenty of stocks out there. The market should be saying, okay, here are the stocks to buy. You'll see these stocks in plenty of IBD stock screens and stock screens at investors.com. But if leadership is sort of hard to identify when you see a follow-through day, that's a sign to proceed cautiously. When it comes to market tops, again, it's just about recognizing when institutional investors start selling stock. They're so dominant in the market, you always want to pay attention to institutional selling when it starts happening in the major stock indexes. Now let's shift our attention to technical analysis. Keep in mind that successful stock selection is about using both fundamental and technical analysis. Start by identifying stocks showing outstanding earnings and sales growth, then use a daily and weekly chart to find the right time to buy. IBD has decades of research that shows certain chart patterns repeat again and again. You'll learn how to recognize several chart patterns, including the cup with handle base, the double bottom base, and the flat base, just to name a few. But technical analysis is more than just identifying a pattern. It's also important to recognize elements of strength and support within the base. Let's get started.